Hello, everyone. This is Sébastien Mc Mahon from iA Financial Group. Welcome to this webinar to kick off the year 2022. So the outlook for next year. So 2020 was the year of the virus, 2021 the year of the vaccine, 2022 can label it as the year of uncertainty. And what better time than right now to look at how the story could unfold in the coming year on fixed income, Canadian equities, US equities, with some of our star managers here at iA. So I will be joined by a few guests here. First, Alexandre Morin, our principal manager for fixed income here at iA. Alexandre has 25 years of rich experience in fixed income, manages $7 billion. So one of the important parts of our lineup. Alexandre, you'll be hearing from him first. After that, you'll be hearing from Marc Gagnon. Everyone knows Marc, love Marc. He's been a strong performer through the years, a good teacher of investment practices, 30 years of experience, over $3 billion under management. So Marc focuses on Canadian equities, so we'll be digging into that. And last but not least, Jean-Pierre Chevalier, our PM that manages US equities. You know him especially for the thematic innovation funds. So GP will show us why even if the US stock market is expensive right now, there are always some opportunities for those who know where to look. So we'll go into that in a few minutes. Before that, I will take a few minutes just to look at the big picture, just macro financial picture where we are at right now. So let's start with the business cycle. So the line here is the global business cycle over the last 20 years. So the higher the line, that means the stronger the growth. And when the line is low, that means you have a contraction. And the lower it is, the deeper the contraction. So as you can see, we are still in very, very healthy territory for growth. The easy part is probably behind us. Following the recession, we had a strong rebound in the global GDP. We pretty much just shut the lights on the global economy and then turned the lights back on slowly but surely. So we had very strong growth in late 2020, early 2021. Now we're starting to cool off a little bit, which is very normal. So it's what you want. You can't have too strong growth forever. Fiscal stimulus, monetary stimulus, and we will still probably have above trend growth in 2022 around the world for GDP, for economic growth. So we're still in very healthy territory. But the easy part is behind us for the markets. Now active management will take all its meaning over the coming year and years. So inflation, of course, the topic of the hour. We were expecting inflation to creep its head in 2021, but we were surprised by how strong it came in at the end of the year. As you can see in the chart here, it has more to do with the prices of goods than services. So when you look at inflation, is the inflation in the consumer price index, and we buy goods and services, more services than goods, but because of the pandemic, the distribution shifted, turning all of the lights back on, as we mentioned, means that we'll have some frictions in the supply chain. So prices for goods have been jumping quite strongly. As I underline in the chart, these factors should be temporary, but there's a lot of uncertainty around that, but that's still the base case. I think probably as we'll move forward in 2022, inflation should be moving lower or slowly, but it's still going to be an important topic in 2022. Central banks will be tightening because of that. So Alexandre Morin will discuss this topic for us in a few minutes. Stock market, the S&P 500 on the left was very, very strong all through 2021, and it was the buy the dip strategy that won the day. So you can see the red dashed line here is the 50-day moving average. Whenever we touched it, we kind of bounced on it. So the US stock market had a total return of about 28% in US dollars in 2021. The TSX was not far behind at 25%, but the TSX is rather small around for the global stock market. So when you look at the chart on the right, all of the ACWI ex-U.S., so all country world index, when you remove the U.S. from there, pretty much sideways all through the years. The U.S. is expensive right now. Around the world, you have pockets of valuation. You have many stories that are competing together. So we'll discuss all of this with our managers over during this webinar. So let's start with fixed income with Alexandre Morin, market views and positioning. So many interesting things going on. So I pass it over to you, Alex.
Thank you, Sébastien. Thank you for letting me the opportunity to express me and my team's view about the fixed income for the coming year. First, also, I would like to wish everyone a good year 2022, hoping the best for everyone. Yes, let's say that 2022 will probably another challenging year for the bond market and for the managers involved in the asset class. So far, we are a week and a half in this new year, and we can say that it's been a heck of a year with quite a big sell-off, especially witnessed last week. Just to give you an idea, the sell-off that we witnessed in the first week of this year is the equivalent of 40% of the sell-off that we witnessed in the whole 2021 year. So it's pretty impressive, and it won't, as far as I'm concerned, continue at that pace. Here, what we see is that since last fall, we saw the central bank's communication evolve quite rapidly. We feel that these people, either in Ottawa and Washington, are getting a little bit more nervous about the inflation, and it has its repercussion in the bond market. Here, we see on the left side what the market expects as it relates to the number of increase that is expected from the Federal Reserve for the year 2022, so close to 4. And on the right side, it's the same thing, but here in Canada, and it's 6 hikes are expected from the market as it relates to the conduct of monetary policy by Tiff Macklem. As far as I'm concerned, I think 6 here in Canada is a little bit too much. We should be closer to 4. But let's mention here that the next central bank's meeting, which will be held on the same day, on January 26th, will be very important, either here in Canada or in Washington, to see what will happen in the next few months. But I think you can have as a base case scenario a hiking cycle that will start probably at the end of the winter or at the latest at the beginning of spring 2022. So if we go on the next page, another important topic will be the central bank's balance sheet. Here, I'm talking specifically about the Federal Reserve, but the graph that I'm showing to you is the source of demand of U.S. Treasuries. I've highlighted the Federal Reserve. As you can see, in 2020, they bought quite an astounding amount of U.S. Treasuries. It was much lower last year in 2021 and will certainly be lower, maybe even negative in 2022. Jerome Powell, who spoke in front of the Senate Banking Committee 48 hours ago, mentioned explicitly that he found that the balance sheet at close to $9 trillion is way too big for what the economy needs right now. So this is what we call the quantitative tightening. The reduction of the balance sheet is something that will probably start in next summer. But when we say reducing the balance sheet, doesn't mean selling bonds outright in the market. Just for your info, the Federal Reserve has many maturities in its portfolio. So the way they reduce the balance sheet is they go with what we call caps. And when maturities come around, they decide X number of billions dollars of bonds won't be renewed. So this is a passive reduction of the balance sheet. So in the end, it's going to leave the market, the U.S. Treasury market and other bond market in the hands of private investors, which are more sensitive to the price of the bonds. So this is another aspect of the market that could lead us to higher yields in 2022. If we go on the next page, I put this graph just to give us some context here. We've been hearing often that since the 1980s, the bond market has been in a bull market, meaning that the price have increased year in and year out. That was true until 2012, so 10 years ago. As you can see on this graph, since 2012, so the end of the financial crisis and the European crisis, we can see that we witness up years and down years as it relates to the bond yields. Here, the blue line is the 10-year U.S. Treasuries. The red line is the equivalent, but here in Canada. We first thing we can witness for the last 2 years is that all the gains that were witnessed, the huge gain that were witnessed in 2020, were all given back by the market last year. And we are getting even closer to the median of the yield that we witnessed here in Canada in the last 10 years, and getting closer to the same metrics in the United States. So here, I don't think the sell-off that we saw last week can go at that pace for much longer. I think, you know, if a 10-year bonds start trading with a 2.25 yield attached to it, I think it's going to represent good value. And also, as witnessed at the first week of the year, two fast increase in bond yields give some problem for the stock market. We saw it in the United States last week. The S&P 500 had some problem with those rising yield. So and also keep in mind that the bond market is a global market. So if bonds are getting too cheap here in North America compared to, let's say, a 10-year bonds, which is still yielding a negative yield, it makes an interesting proposal for international investment. If we go on the next page, Sébastien, please. So here, I'm talking specifically about corporate bonds. The graph that I'm showing you here, and if you look at the right of this graph, it's to show you that 7 years out of 10, the additional return of corporate bonds is higher than government bonds. So either you look in a situation that rates go down or rates go up, 70% of the time, you're better off being invested in corporate credit instead of government credit. The last time we had negative return on the asset class was in 2018, but keep in mind that in 2018, the overnight rate south of the border in Washington was 2.5%, while it was 1 3/4 here in Canada. Right now, we are at close to zero here in the United States. And so we still think that even though spreads are tighter than they used to be, corporate bonds are still a very good proposition for our portfolio heirs. So if we go at the last page, so as mentioned before, the coming year will probably be another volatile year for the bond market in the context of rising yields for the reason that I've explained in the last 5 minutes or so. So in that context, what are we going to do as a team to protect our portfolio in such an environment? The first thing that there's actually two pillars. First thing is owning securities with short maturities. The shorter maturity you buy, the less its price move for a given movement in the yield. So what we think for the portfolio, we're better off owning securities with short maturities here. Keep in mind that with the active central banks that we will witness in 2022, combined with the governments that tend to issue more and more longer-term debt, it's going to push yield higher. But also, as we always mention, our duration management is always something that we like to be active. So we can be sometimes very short, sometimes less short, maybe sometimes even a little bit longer than our benchmark. Didn't happen in 2021, but we never know what the future can bring us. And also, we really like to use the interest rate futures in the United States, which are the most highly liquid securities in the world. We can be very nimble in our duration management with those products. And as I just mentioned a couple minutes ago, we like to be overweight corporate credit, even though their past performance, they remain at an attractive investment for our portfolios. Yes, risks are more balanced because their credit spreads are tighter than they used to be, but keep in mind that in the fixed income world, the search for yield mantra is still very well alive. So that's it for my part. Sébastien, back to you.
Sure. Thank you, Alex. And yeah, so volatility in bonds in 2022, I think everyone can expect that. 2021 was a very rare negative year, as we've mentioned, for the global bond index. Since the mid 1970s, it was only the fourth time that we had negative returns on the year. So for balanced portfolios, for everyone's assets out there, it's always good to have some fixed income for diversification purposes in the portfolio. So that doesn't change with post-COVID or with inflationary pressures. So now maybe going home, Canadian equities. So with our good friend Marc. So Marc, hand it over to you.
Oh, thank you, Sébastien. So, hi, everyone. I will start by showing the slide. You know, we had a very good returns last year for both Canadian and U.S. equities, above 20%, which is all agree. We all agree it's excellent. But what's interesting for the Canadian market is valuation. Valuation is much less demanding than the US right now. If we look at 22 price earnings, so next year, if we forget the first 12 years of this year. So we're around 15, even a little below times price earning in Canada right now, and close to even a little above 21 for the US. So it's a 6 turns difference. And we haven't seen that in a while. You know, you can see on this graph, we go back almost 20 years, and we've never seen that kind of spread between the two markets. So the two markets. So we're quite, we find that quite interesting. We know also that the Canadian market is exposed to cyclical stocks. And like you just said, Sébastien, and also Alexandre alluded to, we are in an inflationary push environment. Maybe it will peak. Actually, it will peak, I hope, because at 7%, I don't want to see it go a lot higher than that. But it would remain for a while. And what will be the pace of this deceleration, that remains to be seen. So I think that the cyclical that are usually a good place to be in this kind of environment will continue to bode well for the Canadian market. You know, what I like also, it's not only the macro view regarding commodities, it's also what I would call the more ground toward bottom up view. And we can see that with the next graph. When we look at actually the graph on the left, we can see what have been the investment on a worldwide basis in industrial metals. So as a percentage of the worldwide GDP, it's the blue line. And you can see that in recent years, maybe 3-4 last years, it's been a little below the average of the last 15 years. But what we can also see is with the dashed blue line, we can forecast what will be the investment in those sectors, in those commodities for the next 5 years, because these are really long lead time projects. From the time you start to think about them and the time they are in production, it takes several years. So we know that investment in that sectors, there's nothing really tremendous in terms of quantities of project on the drawing board right now. So we see that investment will go down, and it's quite interesting because we see prices go up right now. And that, I think, support a thesis that I had in my mind for some time already, that we see now producer around the world of different commodities not going after volume, but going after prices to increase profitability. So if we look at the small graph on the upper right, you can see that even though demand, the offer is responding, we can see that with the red line, actually supply, prices are still going up. But the problem is that inventories are going down, even though if supply is increasing. So we don't have any cushions to withstand, you know, the decreasing investment that is forthcoming in the next years. So that could lead to an environment of pretty fundamental, strong prices for commodities. And if we dig a little further in energy, and that's what we're going to do with the next slide, we can see that on the same is happening with oil right now on a worldwide basis. You have to know that every year we're losing about 3 million barrels of production, 3 million barrels per day of production, just because of well depleting. So every year you have to replace that to keep production constant. Is 3 million barrels per day is a lot? Yeah, well, to give you a clue, it's a 100 million barrels market per day. So it's about 3% that goes away every year. And looking once again at what is expected in terms of investment, and it's possible to forecast that once again because these are long leads projects for most of the production out there, you can see that we're forecasting that production will never be, added production will never be above 2 million barrels. It's going to be in 2021 and 2025, and it's even going to be a little bit below 1.5, so half of what we need to replace production. So maybe you're going to tell me, hey, Mark, anyway, we don't want we don't need oil. We don't want to increase production in oil for the sake of climate, for the sake of the planet. And I surely agree with that. But the problem is we might need to continue to produce as much as oil as right now for maybe the next couple of years until we see a new technology being introduced. And you have to not to forget also that the petrochemical industry that is a big demand, use a lot of oil, is also still growing in the emerging economies. So let's look at three different scenarios. The one with the dark dash line, the blue line, and the red line. The dark line, the dash dark line indicate that if demand stays where it is for the next 20 years, supply will go down significantly, and we will end up with a gap of 70 million barrels, which is an incredible gap. It's probably not going to happen, because I hope so, because prices will go to a level that I cannot foresee. It's going to be very, very high. So let's say, for example, we're going to use the United Nations sustainable scenario, which is the blue line. The gap will still be very important, and you see oil usage decreasing. And if we use the 2050 net zero emission policy, you see that there will still be a gap. So production will have to increase at one point, but we will probably be undersupplied for some time still from now on. So I think that bodes well as an investor for the energy market, which is still an important sector in Canada, as you know. So maybe you're going to tell me, okay, that's nice, but we know that the energy sector was the best performing sector in Canada in 2021. Is it still time to invest in that sector? It's probably expensive right now. I would say, yeah, you're right. That was a very interesting performance for that sector in 2021, but the commodity has improved much, significantly more than the stocks themselves. And that translates to valuation, and you can see that with both graphs on the right side, where when we look at 2022 price to cash flow, they used to be around 6 when I started in the industry back in the 2000 years. Now the average for the last 5 years is around 4, and we're even below that at 3 for the small cap valuation, and 3.6 for the large cap, when the average is closer to that 6%, 6 times that I alluded just before. So valuation is still on our side. That's pretty interesting, and the fundamental is quite compelling. So I think that's bode well for Canada. But I think that overall, the Canadian market, and we can see that in my conclusions, will be an interesting place with some attention for several quarters to come. we think also that in that kind of environment, financial are not doing too badly too. They have been performing very well in 2021. In Canada, that's the second best performing sector. Good start of the year, and it should continue as long as we see the current economic environment last. And that should be for a couple of quarters once again. So, and it's a very important sector in Canada. It's above 30% in the weight of the index. So overall, I think that the Canadian market, it looks pretty interesting for 2022. That's it for me, Sébastien.
All right, thank you. So the TSX in 2020 kind of lagged the US market in 2021, what 28% in the US, 25% in Canada. So a strong performance, but it's good to see that now. Just to make a joke on what you said, there's a lot of fuel left in the tank for the Canadian stock market. Valuation is attractive. So yeah, in our strategies in the diversified funds, we like the Canadian stock market quite a bit. So mentioned that the US stock market is expensive as a whole. I think everyone agrees, but not because the whole is expensive that there's no opportunities left. And who better to discuss that than the king of thematics here at IA, our friend JP Chevalier. So JP, up to you.
All right. Thank you, Sébastien. I took time to remove the crown before I start speaking, so you just settled me as a king. So, but I'm just kidding. So yeah, U.S. equities. I mean, fascinating market for the last 10 years, I would say. Right now, even though the indexes, when you look at NASDAQ 100 or S&P 500, they're still near record level. They're still not near the historical high. But I thought it was interesting today to share what's really happening under the hood. And I took the NASDAQ here, going through a stealth correction. That's the number of new lows, so new stocks that are making 52 weeks lows. That's now at a level similar to the great financial crisis and also of 2001. So what does it tell us? It means that a lot of stocks are in correction territory right now. The situation these days, it's really from the start of last year. Two things happened. So there was a lot of, let's say speculative situation when we talk about meme stock, when we talk about the overload of IPOs, of SPACs, a lot of let's say bubbly situation in the new energy category related to EVs, related to battery technology, all of that. So those situations have started to correct, but while correcting, it kind of took everything with it at the same time. So a lot of situations that haven't really been effect from a fundamental point of view, that have strong structural growth opportunities ahead of them, and that are down somewhere around 20 to 40% in some situations. So it's really an interesting environment. So let's say last year, especially in the mid-cap sector, so mid-cap have lagged over the last year. They're now at valuation level not seen versus large cap since a long time. So the point I want to make here is don't underestimate what's currently priced in terms of rate increase and macro situation at the individual stock level, but be wary at what might happen at the index level. If we take the NASDAQ here, top 10 position is over 54% weighting of the index. So a lot of people go passive. They say I will be more diversified, but that's not what's happening when you pile into the NASDAQ these days. As in a position in our fund, we're just closer to 30% when it comes to our top 10 weighting. Over the next slide, so people might say, okay, so there's been a little bit of a correction underneath the hood. The index looks maybe a little more fragile. Expect heightened volatility in the next few months, the next quarters. So what about cyclicals? Well, cyclicals, they look relatively, let's say, stretched. This graph here shows the performance of the S&P 500 cyclical group versus the more defensive one. So let's say your financial versus your healthcare as an example. And it shows that since vaccine announcement, it's really been a parabolic curve to the upside. We're now reaching 2 standard deviation in terms of relative performance for one or the other. When you reach those levels in the last 20 years, it hasn't been really, let's say, quite conducive in terms of piling more into cyclical. So you might say, well, everyone on CNN and CNBC say it's time to buy cyclicals. Even the cover of the Barron's over the weekend was about buying commodities. As I said, the rubber band is looking a little bit more stretched. Those industry groups are high beta, and in a heightened volatility situation, beta is not your friend. So we're a little bit more, let's say, conservative when it comes to cyclical exposure. And if we continue over, for us, this situation, it's really the start of the hunting season. Over the next slide. Please. So stock picking season, hunting season. I didn't want to make any joke about killing animals, but killing it in terms of performance is really what stock picking seasons is helping us to achieve. So here we have identified themes that are dislocated, over 30 stocks with large alpha potential. Those stocks are within the theme that are listed on the screen right now. To give you a few examples, maybe let's start with connectivity in the digital platform. Doing a lot of works on Uber right now. Uber is seen as a reopening stock with their rideshare business, but what gets overlooked is the restaurant delivery. The Uber Eats business actually went from 15 to 50 billion booking over COVID, and they're just starting to do delivery with groceries in the U.S. Groceries are 1 trillion market. Restaurant is a 600 billion market, so it's much bigger. And at the same time, we expect the rideshare business. Let's say the expectation are for the rideshare business to come back to pre-COVID over 2023. So it's not really, let's say, high expectation. And we see this company becoming, let's say, doing over $1 billion free cash flow this year, quickly growing to over tens of billions of free cash flow over the next few years. For an 80 billion market cap, we think people, once the macro situation allow us to lengthen or stock horizon a little bit, that's a stock that is going to perform. And maybe quickly another one. Let's go in next generation healthcare. In biotech, like I said, the small cap biotech index significantly lagged last year. It actually lagged more than 50%, 50, the S&P 500. It's never been seen really in history, kind of lag of this index in such a short period of time. We think it's overdone. We think there's a lot of coil spring potential alpha situation in that industry. And we're currently, like I said, I mean, our investment process allow us to identify stocks with potential, so we're ready when the time comes or whenever we have better opportunity to buy them. So to conclude, over the next slide, like I said, it's not unusual to have higher volatility as Fed starts tightening. So we're expecting the first rate rise over the next 60 to 90 days. Based on current expectation. So the market will need to consolidate the gains of the last few years, in my opinion. Let's not, I mean, let's tell the truth here. The market don't go in a straight line upward right to the right. It needs to consolidate. There's sometimes some correction as well. That's where risk management is very important. So there's a lot of strategies out there that are labeled as thematic or innovation that don't really seems to put risk management central to their investment process. That's not what we do. So we like to invest where there's structural growth and an interesting risk return when it comes to upside, downside. Lastly, it's stock picking season. We think over the next few months, there will be a lot of opportunity to take advantage of higher volatility. We think it's a time where the thematic investment process will shine in order to drive good alpha over the balance of the year and the next few years, also 23, 24. Like I said, we're already identified which stocks we're looking to add to our portfolio. When it comes to risk, Obviously, the supply chain not improving into 2023 is something we take a close look at. Like Sébastien said, inflation seems to track the mix of demand. So if demand doesn't tilt back to services and supply chain is still having a problem, it might lengthen the problem with inflation. Something people don't talk enough, the China's COVID management situation. They will have to get out of zero COVID policy at some point. Will it be after the Olympic? Will it be after in the fall later on? So the fact that we're reaching 30 to 50 positivity rate in testing in developed market, and China is still looking to put on lockdown millions of city with millions of people population. At some point, something will gotta give. We think it could bring a lot of uncertainty to global demand. And lastly, we have the midterm in the fall in the U.S. So might be some political turmoil. Nothing specific to pinpoint, just to point out that it's been the norm to have turmoil in the last 10 years, even more. So something might happen there. So something to closely monitor as well. And with that, I'll turn it back to you, Sébastien.
Thank you. And you're right. Markets don't go up in a straight line. Volatility is normal. Corrections happen, but even if the market's expensive, there's always some opportunities and some competing stories to add value. So great presentation on that. So maybe now let's go to questions. So we picked a few questions that were sent ahead to us for this. So maybe let's start with inflation, and I could start with Alexandre and Marc for this one. So maybe Alexandre, how in fixed income inflation is a big thing. So how do you protect your portfolios for rising inflation?
Okay, thank you for the question, Sébastien. So the way we want to protect our portfolio against a rising inflation means obviously higher bond yield. So as I mentioned in my conclusion of my formal presentation, we prefer to buy bonds with shorter maturities. Their price will move way less than longer term bonds if yields continue increasing as we saw in the last few months. So this is one way we think is a good way to protect our fixed income portfolios. Also, usually in a rising yield environment, credit should perform better on a relative basis to government bonds. So we like to be overweight credits, especially corporate bonds, again with a short maturity, in order to give some extra basis points for the portfolio. One thing we could have done as well, but we're not invested in that asset class right now, is what we call the real return bonds. For those of you who don't know that asset class, those are bonds that that see their value increase as the rate of inflation increase. But keep in mind that this market, especially in Canada, is not a very liquid one. As you mentioned in the introduction, Sébastien, we have quite a big amount of money to manage. So in order to have let's say a good position in it, it would mean having too much of these bonds which are not very liquid. So in the end, short maturities, credit, I think, is the way to go for our portfolios in order to protect against rising inflation and rising bond yields.
All right, thank you. And maybe turning to you, Marc, I don't know if we should ask the question the same, because maybe inflation is not as much of a risk for Canadian equities and more of an opportunity. So what do you do with the inflation background?
Well, yeah, like I said, and you know, there's a lot of sectors in Canada. An important part of the stock market that is you know, in that kind of environment to tend to do well. And fortunately enough, like Jean-Pierre alluded, the U.S. market is expensive on the cyclical fronts, but in Canada we are much less expensive. So I see that as a plus for the Canadian market. So that's the offensive part of our strategy. But we do have also a defensive part, which is wondering, you know, what company will be impacted negatively by inflation. what are the companies without pricing power? What are the companies with the cost structures that is vulnerable to inflation? And especially we're thinking here about labor inflation, because we know that compensation and salaries are going up more rapidly these days. So which companies are labor intensive? This is a kind of thinking we have to try to avoid companies that may or will underperform because of earnings below expectations. So there's a lot of work being put on that aspect too, and I think that for those that know me for a while, you know that risk management is very important in my portfolio management. That's why in the last 20 years, I'm the good size of being in that industry and being that old, and I can say those kinds of things. You know, with the Canadian Equity Growth Fund, I've been in charge of that portfolio for that fund for 20 years now. There's only 4 years that I was below the index and one that I was almost even. So risk management is very important. So we're trying to do to gain basis points on the offensive fronts. We're trying to save some on the defensive one, and in a very measured manner. We don't want to bet the house on one thing. That's not. We're not looking for a home run. We like a very high batting average. That's our interest here.
All right, good, thank you. And yeah, risk management is key. So you're not Paul, you're wise, Mac. I would say that. So maybe turning to JP, maybe 2 questions for you. So. At the beginning of COVID, the work from home trade, the Peloton, DocuSign, Zoom stocks were really hot. And now we've seen maybe a blow up of that. So can you explain how market views have changed on these teams?
Sure. Well, like I said, lots of action in the last few months when you look underneath the hood. Those stocks that you referred to that were identified as work from home or COVID winner, I would say when you look at it in hindsight, you would say it's pretty easy with hindsight. But the thing is that the stock just went up too quick, too high, too quick. So when you look at the overall 2020, 2021, the performance was still okay, but the market got, let's say, a little bit, I would say, very, very positive on those situations, and it started to incorporate a growth rate that was much higher than the potential total addressable market that these companies could address. But I would say the important thing here, it's important to not put every company in the same basket. I mean, CNBC and financial media like to do baskets of stocks and show you the performance, but that's not how it works in the real world. In the real world, you have companies that benefit from COVID that didn't correct it as well. You got blow up like you just mentioned. So the important thing is to separate the winner from the loser. Another example with big tech, people talk about big tech as one big giant entity, but it's totally nonsense. I mean, just last year Google made 60+%. Amazon was flat. Amazon's been flat for the last 18 months. So it's important to look at each company on the individual level. And like I said, there's been a lot of correction in many situations. The company you mentioned, I would say that the market is still pricing too high of a growth rate, but there's a lot of other opportunity that are now, we think, starting to scream really interesting here.
All right, thank you. And maybe staying with you, there are always some important themes in the markets. A few years back, it was all about cannabis stocks and then crypto, blockchain, and now we're hearing about the metaverse. So can you just explain what that is? And I mean, is this an investment opportunity?
Sure. Well, the metaverse, Web 3.0, how the crypto debate has evolved. It's all part of the same question: how the internet will evolve from here. The basic answer, it would be much more social, much more immersive. People tend to think about it as you need to put a VR headset, and now don't go out of your home anymore. That's not really the debate. I don't think the debate is about the medium. I think the metaverse exists right now as we're speaking. It's just called Call of Duty. It's called Roblox. It's called any other environment where people go to game or socialize or do any other thing. So to answer your question, I think it's the natural, it's not a revolution, it's the natural evolution of the internet. And from that will come much more optionality when it comes to innovative business model or existing business model that could benefit from that. It could also be quite disruptive when you merge that with a potential Web 3.0. It could be disruptive to the current construct of the internet, but we're not there yet. Yeah, that might be a debate for 2026. So we'll come back on that later on.
Yeah, and we're already hearing that people could have jobs in the metaverse and make a living there. So interesting theme for the next few years. So maybe back to Marc. ESG and the Canadian energy sector, we know that there's been maybe sometimes not been in the good press for the Canadian energy sector related to ESG factors. So can you give us a picture of where we're at now?
Yeah, and I will take the opportunity also to tell you how I see that evolving and how we react to that too. That's very important as an investor, because I'm pretty sensitive to what's going on, of course, with the climate and the future of the planet. But do we have to really avoid energy stocks? I don't think so personally. What I see and what I take is, and you see that also in the U.S. where ESG exclusion strategy, where you avoid completely a sector or gain a lot of importance up to two to 3 years ago. Now what they call is more impact ESG, where you look for good companies that are making a difference, companies that are improving on the ESG front, and that's, I think, what is important. Especially that, believe it or not, some energy companies in Canada are part of the solution and are not part of the problem. I will name you two interesting cases here. The first one is Whitecap. They're really ahead in terms of carbon capture storage technology. They are putting CO2 back in the ground in their oil reservoir using their oil wells, and this way all the CO2 that they produce for extracting their oil is being re-injected, and even more because they have connected some industries nearby their field, and they're injecting even more than what they're producing. So that's a perfect example, and we know that carbon capture technology will be part of the solution in the near future. And the other player in that concept of capturing CO2 and injecting it back in the ground is to capture it at the just at the exit of the chimney, at the exhaust of the chimney of several plants, for example, cement plants. And you have Advantage Energy that is right now testing a technology that is very promising in terms of cost. It will be very cost-efficient way to capture CO2 for different industries, and being sent back, injected with example as we just alluded to, like Whitecap. So these are a good example of energy company in Canada being part of the solution. But beside that, all the companies that are reducing their green gas emissions are of an interest for us. We want to invest in good citizen even in that sector, because we will need it for a while still. So that's how we manage ESG and energy in our fund.
All right, thank you. Very interesting. So maybe a last question, started with Alex, maybe I'll end with you. We hear a lot from advisors that they have clients, even for themselves, are asking, well, if we could have a tough year for fixed income, should I move the fixed income part of portfolios to cash, to GIC? So what products do we have in the lineup that you manage that could be a solution in this kind of environment?
Yes, a great question, Sébastien. Yes, actually, when most of the people think about the fixed income here at the iAIM, everyone is thinking about our flagship fund, which is the IA bond fund, which is a pretty big fund. It has close to 3.4 billion in assets as of this morning. But we have other solutions if people are afraid that long-term yields could rise more than expected. We have the IA short-term bond fund, which invests in bonds with maturities shorter than 5 years. So it is obviously a fund that will be less impact by an increase in bond yields. And also it is a fund which is quite heavily invested in credit, because in the short end of the curve in Canada, the search for yield is even more present than the longer part of the yield curve. So that could be an opportunity if you or your clients are nervous about long-term yields for 2022. And also, we have a brand new solution that's been online since the end of October. It is called the Fixed Income Managed Solution. Quite a different product than the short-term bonds of the IA bond fund. It is essentially a fund of fund actively managed. So it's a fund with a short maturity as well, but we invest in funds units of likes from fund providers such as PIMCO, Loomis, our friends also at IA Clarington. So it gives for people who invest in that solution, it gives you an exposure to the global bond market, credit as well, but credit not only in North America, and can be almost everywhere on the planet. If you think of a big investment firm like PIMCO, they have the capabilities, to capture value added in almost every market. So it is, I think it could be an interesting solution also for people looking to invest their money in the fixed income space, other than your usual core bond fund.
All right, thank you. So all right, so I think that wraps it up. So thank you. The wealth of experience here, many good points made. So 2022, there are many opportunities out there to those that are opportunistic, and active management is always key. So maybe before we leave, just 3 principles. So invest early and systematically. Manage your emotions, stay invested, and most importantly, talk to your financial advisors. So thank you everyone for following us, and a happy 2022 to everyone out there.